Howard Marks believes that in the world of investing, risk is not what most people think it is. Many assume risk equals volatility or dramatic price movements. But Marks insists that true risk is the possibility of permanent loss. That single idea reshapes everything about how an investor should think. Because if risk is permanent loss, then asking how much could I make is far less important than asking how much could I lose? Yet in bull markets, investors tend to forget this simple truth. It's human nature. When everything is going up, risk feels invisible. People convince themselves they're geniuses. Confidence rises. Due diligence fades. And irrational optimism spreads like a virus across the markets. Marks argues that the most dangerous moments are often when things look safest. Why? Because we stop questioning. We stop doubting. We stop protecting ourselves. If everyone around you is saying, "There's no way this can fail," that is exactly when the seeds of future losses are planted. Marks famously said, "Risk is hidden when it's high, and visible when it's low." When stocks crash, the risks are already realized, and what's left is often opportunity. But when stocks soar uncontrollably, risk quietly builds beneath the surface, waiting to strike. Do you recognize that dynamic in yourself? Are you more confident buying when prices are high and headlines are euphoric? Or do you become interested when fear dominates, prices are low, and bargains emerge yet everyone else is terrified? Marks challenges us to confront our own psychology because risk perception is not about numbers, it's about emotions. Our brains trick us into believing that recent trends will continue forever. When things go well, we expect more of the same. When things go badly, we panic and assume disaster is permanent. Howard Marks calls this the cycle of emotions, a dangerous pattern investors repeat throughout history. Understanding risk means stepping outside that emotional whirlwind. Consider this: what if we approach investing with humility rather than confidence? What if we constantly assume we might be wrong? Marks says the biggest risk is not the risk you see, it's the one you ignore. The unseen dangers are the ones that destroy fortunes. That's why he emphasizes second-level thinking. While the crowd focuses only on potential returns, a superior investor asks deeper questions like, how much optimism is already priced into this stock? What if the future turns out worse than expected? Are investors buying due to fundamentals or simply fear of missing out? Second-level thinking requires imagination, imagining outcomes people dismiss. It requires skepticism, doubting the stories markets love. It requires discipline, saying no when the world around you screams yes. Many investors fail not because they don't analyze data, but because they don't analyze behavior, especially their own. Marks argues that managing risk is not optional, it's the essence of investing. Anyone can profit in a rising market. The true test comes when the tide turns. And it always turns. He often reminds investors that financial history is a graveyard of those who believed this time is different. In a way, Marks' philosophy isn't about outsmarting others, it's about outlasting them. Because survival is the first rule of wealth building. If you avoid catastrophic losses, compounding will take care of the rest. But if you gamble recklessly and suffer huge drawdowns, time becomes your enemy, not your friend. Think of two investors: one makes steady returns for decades, avoiding big mistakes. The other aims for the highest returns but occasionally crashes with devastating losses. Who ends up wealthier in the end? The answer might surprise you. Marks wants us to escape the myth that only high risk brings high reward. He argues that the best investors aim for superior returns with below-average risk. But how? By understanding cycles, human behavior, and most importantly, knowing what not to do. Imagine being the person who steps back when the crowd stampedes forward. Imagine having the courage to hold cash when others chase bubbles. Imagine avoiding the hype that makes fortunes in the short term but destroys them in the long term. Are you prepared to be that kind of investor? Are you willing to look foolish in the moment to avoid looking foolish forever? Howard Marks teaches that risk control isn't dramatic. It's not flashy. It doesn't get you applause. In fact, taking less risk often means missing out temporarily while others celebrate. But when the cycle shifts, when markets crash, those who respected risk are the ones still standing. The question is, will you be one of them? Seeing risk is the real skill. Howard Marks often says that in investing, you cannot control the future, but you can prepare for it. This statement, while simple, carries extraordinary wisdom. Many investors focus intensely on predicting market moves, trying to be the fortune tellers of finance. But Marks believes prediction is a fragile crutch. Real success comes from recognizing and understanding risk at all times. In his view, risk is not what most investors think it is. It's not volatility, price fluctuations, or scary headlines. It's the permanent loss of capital. It's making irreversible mistakes. And it's often invisible until it's too late. So the real question is, if risk is invisible, how do you see it? Howard Marks answers, through judgment, skepticism, and awareness of the cycle. It's not about being scared, it's about being alert. Investors must constantly ask, what could go wrong that others are ignoring? To fully understand Marks's philosophy on risk, we need to explore 3 of his key beliefs that distinguish smart investing from blind optimism. First, most risks are created during good times, not bad times. When markets boom and confidence is high, people let their guard down. They start assuming that good results will continue indefinitely. Investors trade analysis for hope. They stretch their expectations. They stretch valuations. They stretch reality. It is during these psychologically optimistic phases that investors unknowingly plant the seeds of future disaster. Only when the cycle turns, when prices fall and fear returns, does everyone suddenly discover that risk was there all along. Marks reminds us, risk is like radiation, you don't feel it until it's already hurting you. Some of the biggest financial crises offer lessons: the dot-com bubble, the 2008 Great Recession, the crypto crashes. For each, the pattern repeats. People believed a new era had arrived, one where old rules didn't apply. But Howard Marks teaches that the rules always apply, they are simply forgotten when excitement replaces discipline. So he asks investors a crucial question: are you thinking clearly when everyone else is celebrating? Second, the crowd is usually wrong at extremes. Marks warns about herd mentality when investors copy each other rather than think independently. Crowds can create illusionary safety. If thousands of people are doing the same thing, how could it be dangerous? But history shows that the majority is often most confident right before a collapse. When enthusiasm becomes universal, who is left to buy? When pessimism becomes universal, who is left to sell? This is where Marks introduces the idea of second-level thinking. Average investors think, the company is great, so I'll buy the stock. But second-level thinkers ask, is the company already recognized as great? Is the stock priced as if everything will go perfectly? What if expectations are too high? The goal isn't to follow the obvious, it's to understand how much optimism is already in the price. A great company can still be a terrible investment if its stock is priced beyond perfection. Marks challenges investors: are you using your own brain, or borrowing someone else's optimism? Third, managing risk means preparing for multiple outcomes. Many investors treat the future as if it has only one path, usually the optimistic one. But Marks insists that the future is a wide tree of possibilities. Any branch can become the reality. You must invest with resilience, not hope. Avoid situations where only perfection leads to profit. Avoid leverage and strategies that collapse under pressure. Shape a portfolio that can survive storms, not just sunshine. You don't need to know exactly what will happen, only whether you are protected if something happens. To illustrate his philosophy, Marks uses a powerful metaphor: driving. The goal isn't to go fast all the time. It's not about taking the highway at maximum speed without looking ahead. The goal is to arrive safely. To stay alert. To slow down when the road becomes slippery. Aggressive investors want maximum returns, but they forget that crashes erase years of progress instantly. Risk is the cliff that you don't see until you're falling off it. Marks encourages investors to build a margin of safety, to leave room for error and uncertainty. But here's something surprising: managing risk doesn't mean avoiding all risk. If you hide in cash forever, you lose opportunity. You must take measured, thoughtful risk to grow wealth. The key difference is this: smart investors take risk by choice, not by ignorance. They take risk they understand. They get paid for the risk they are exposing themselves to. They assess not only the upside reward, but the downside consequences. Howard Marks asks, before you invest, do you know what you stand to lose? Risk awareness also requires humility. Many investors assume they are skilled because they made profits in a rising market. But Marks argues that markets reward beginners by accident. When the wind is strong, even a paper airplane can fly. The test of real competence arrives when conditions turn unfavorable. When everyone else is panicking, disciplined investors remain calm. Marks believes success is not measured only by returns in good times, but by survival in bad times. And here lies one of his most important points: risk is not a statistic, it is a mindset. Tools like standard deviation and beta may describe past volatility, but they do not predict disaster. Numbers create illusions of precision. They cannot measure greed. They cannot measure bubbles. They cannot measure the human desire to ignore bad news. Real risk comes from investor behavior, and human behavior is the most unpredictable factor in finance. Marks emphasizes the importance of constantly asking questions. What has to happen for this investment to work? What if everything goes worse than expected? Am I being compensated appropriately for the risks I'm taking? Am I relying on assumptions instead of evidence? Most importantly, what does the crowd believe right now, and what if they are wrong? Howard Marks encourages investors to seek risk intelligence, the ability to detect danger early, when it's still invisible to others. This requires discipline, skepticism, and emotional balance. It means becoming more cautious when others are excited, and more bold when others are fearful. It means learning how to step away from the herd and think independently, because safety rarely exists where most people are looking. Risk cannot be eliminated, but it can be understood. It can be managed. It can be priced. When others get careless, you become careful. When others panic, you stay rational. That is how investors protect their capital and how they win over the long run. So ask yourself this: do you want to feel safe, or actually be safe? They are not always the same thing. Howard Marks invites every investor to think deeply about risk. Because the greatest danger is not failing, it is not knowing what can make you fail. Seeing risk clearly is what separates the fortunate from the wise. The art of surviving and thriving. Howard Marks believes that investing is not a science with perfect formulas but an art shaped by uncertainty and human behavior. At the core of his philosophy lies a crucial distinction: success is not simply about making money when the market rises, but about protecting money when the market falls. Bad times expose the truth about investors. When fear dominates and chaos surrounds the financial world, decisions made in the boom period come back to judge you. Therefore, to understand Marks is to understand that avoiding regret is just as important as capturing returns. Throughout his memos and books, Marks repeats a message that sounds simple but is incredibly challenging: superior investing does not come from taking more risk but from taking better risk. Most people confuse boldness with brilliance. They assume the biggest returns belong to the most aggressive investors. But Marks teaches the opposite. Excessive risk often delivers disaster rather than success. A strategy that only works when the sun is shining is not a strategy, it is a gamble. Real skill lies in building a portfolio that stays resilient regardless of market weather. He introduces a powerful idea known as asymmetry: always seek investments where the potential gain outweighs the potential loss. This mindset pushes investors to be selective, patient, and rational. You do not need to swing at every opportunity. Investing is not a sport where more activity means more success. Howard Marks reminds us that doing nothing is sometimes the smartest decision of all. When the environment is hostile and risk premiums are low, stepping aside is a form of action, an act of discipline and strength. Marks also emphasizes the emotional side of investing. Fear and greed are the most powerful forces in the market, and they can override logic in an instant. Greed makes investors believe that the good times will never end. Fear makes them believe that recovery is impossible. Both are illusions. The key is to think independently, especially when emotions run high. Marx encourages investors to ask themselves whether they are reacting to information or to emotion. Independent thinking is one of his central principles because the greatest profits come from being right when most others are wrong. But that requires courage and conviction. It means tolerating discomfort. It means trusting analysis over popularity. Another insight from Marx is that risk management should not be something you start thinking about when things go wrong. True risk management happens before the danger appears. It means positioning your portfolio so that even if the unexpected strikes, you can survive to play again tomorrow. The best investors do not aim to avoid all trouble, they aim to be strong enough to endure it. Those who misunderstand this fall into a trap. They chase performance without considering that high returns often come with hidden fragility. In good times, fragility hides behind profits. In bad times, it explodes into losses that cannot be undone. Howard Marks also reminds us that average is the natural outcome of doing what everyone else is doing. If you want above average results, you must behave differently. You must think differently. Superior investing success is never achieved through conformity. But being different is not enough by itself. You must also be correct. And being correct against the crowd is incredibly difficult because the crowd constantly pressures individuals to conform. Marx believes mental independence is a superpower in finance. We must also confront a tough truth: even the best investors will not always be right. Marx openly states that uncertainty rules the market. No one can foresee every scenario. That is why his philosophy emphasizes resilience and consistency over perfection. Winning big occasionally is not enough. You must avoid losing big. The greatest portfolios are not built on predictions, they are built on preparation and protection. Marx frequently refers to the value of humility. When investors become too confident, they underestimate risk. They assume their success is skill rather than luck. They extend themselves too far. That overconfidence is the first step toward collapse. Recognizing uncertainty is not a weakness but a strength. It pushes investors to question assumptions, diversify intelligently, and prepare for different outcomes. It keeps arrogance in check and keeps survival at the forefront. There is a recurring theme in his work: surviving the worst moments is what allows investors to enjoy the best moments. Markets are cyclical. Bad times are not permanent. Good times always return. Those who remain disciplined through uncertainty capture the long-term rewards that impatient investors miss. Howard Marks reminds us that time is the greatest ally of the rational investor and the greatest enemy of the reckless investor. If you protect your capital long enough, compounding will lift you to heights that risk-takers will never reach. The essential question he wants every investor to ask is, what kind of investor do you want to be? The one who chases every trend and hopes luck stays on their side? Or the one who builds a fortress of resilience, carefully choosing when to advance and when to hold back? Howard Marks offers a path that is demanding but rewarding. Think independently, respect risk, act with discipline, and prepare for what you cannot predict. Investing is not about proving how smart you are in the moment. It is about staying smart over a lifetime. When the future arrives, you should not be surprised, you should be ready. In the end, risk is not the enemy. The real enemy is not understanding risk. This is the essence of Marx's philosophy. Those who recognize danger early, who stay skeptical when others are euphoric, who maintain courage when others are terrified, those are the investors who ultimately prevail. As Howard Marks would say, you may not be able to control the market, but you can control how you respond to it. And mastering that response is the greatest edge of all. Every great investor understands one truth: learning never stops. And today, we've explored one of the most powerful minds in finance, Howard Marks. His philosophy reminds us that risk is real, uncertainty is constant, and only those who prepare survive the storm. Now, I want to hear from you. Which of Marx's principles resonated with you the most? Do you believe investors are truly ready for the next wave of market risk? Share your thoughts in the comments below. Your insights help shape this growing community of rational, disciplined thinkers. If you enjoyed this deep dive into the psychology and strategy behind successful investing, make sure to subscribe to the channel. Join us as we continue exploring the wisdom of legendary investors and uncovering strategies you can apply to your own financial journey. Hit that subscribe button, turn on notifications, and stay ready because the next lesson might change the way you invest forever. Thanks for watching, and I'll see you in the next video.